welcome to this video where we're going to talk about risk. Now, what we want to understand is how it works, how you go about calculating it and why you might see some discrepancies when you're on exactly the same instruments, but also why it's so great that Arya does this for you. So the first time you trade a new asset, you need to check the risk on the instrument. So it's very similar to trying a new car for the first time or beginning to do anything that is slightly strange to yourself for the first time. So in a new car, you check it starts, you check that the seat belts work, etc. Now here it's exactly the same thing. So when you trade a new instrument, you need to check the risk. You need to see if that matches the risk that you requested from your broker. Now, the big advantage of Arya is that you can check the risk before you start the trade. So we'll run through exactly how you can do that, and I'll show you how you can check that direction on the graph itself. So the first step is always to launch Arya on the chart, and then I'll advise that you put yourself on a larger unit of time so that you don't risk getting into the position too quickly if it is that the risk is not right for you. Now, you place an order so that you can check the risk, and the way in which you do that is you drag the mouse over the take profit line, also over the stop loss line, and that will give you an indication as to your potential gains and losses. So that's where you can then work out whether the risk is in line with what you asked for. And if it is, then great, okay, let's go. And if not, then we'll look at how we can understand why and see what's going on. So firstly, we're going to look at an example here. Let's say we have a $50,000 balance in our trading account. Now, the example one is where we have an instrument where the contract is equal to $1 a point. Now, if the stop loss, we'll say it's volatility based as XL. Now, on a day where there's not too much going on in the markets, they're not so volatile, let's say Arya calculates you've got 100 points within your stop loss. 100 points, $1 a point, as outlined in the contract, $100. $100 of a $50,000 trading account is a 0.2% risk per trade minimum. Now, if you have exactly the same contract, but it's on a much more volatile day, much more activity, we'll call it, in the market, similar to what we're going through now in March of 2020, similar to what we had in 2008, and these areas of uncertainty, we can see how larger volatility, larger points in the stop loss, the more points, obviously multiplied by, again, that same $1 contract, we then end up with, out of a $50,000 balance, 2% risk per trade as the minimum. So you can begin to see there's a very sizable difference here in terms of the risk per trade, just depending on the volatility of the market itself, even though you're in the same contract. So if we now take the Dow Jones 30 and also the Dow Jones 30 H20, these are very, very similar instruments, but vastly different in terms of the contract sizes that they accept. Now, they don't offer the same contract size at all, nor the same point values per contract. So very, very similar to what we saw just before with the $1 contract, usually that larger contract size being seen in the US 30, but Dow Jones 30 H20, we're looking more at the micro capital contract. So if we open up a trade on each of these instruments using Arya Pro, like we said, initially we're going to launch Arya Pro, make sure that we can bring our risk per trade, we'll put it conservatively for now, 0.25. Now, the other most important aspect is changing that stop loss volatility down to XL. Now, take a quick look at where these 2 points are. So you have a take profit right up here. As mentioned, we just hover over it. 2,453 pips, or $122 as our profit. Now if we look here, minus $81 as our loss, or 1,635 as our loss in pips. So that's our stop loss there. Now we'll do something very similar. Look into the US 30. Now we're going to go through exactly the same process and be able to see if there is any difference itself. So we change this risk per trade, bring that down to a conservative 0.25, and our stop loss down to XL. So once we have these parameters in, again, we're going to buy in the market, giving us a profit of $2,261. And then if we look on our stop loss, that is 150,760 pips, or $1,507. Now when you compare that, our take profit here, 22,000, or 226,000 as our pips in take profit. Exactly the same situation, only 2,400 pips. So look, this is where you see the importance of Arya. Now the risk calculation does it for you, and it's in a fraction of a second. Not using a risk management tool, you can see, is extremely dangerous. So that's why this tool is essential in preserving your capital for the long term. So always, when you trade a new asset, make sure you really look at the risk. It's not as easy as just jumping in. We know that when we started to learn how to drive a car, and we've all been taught in the hardest way possible. But make sure that you understand it. Once this simple check is done, no longer need to do it anymore, and Arya will be making sure that it will take care of everything for you. But once again, thanks for your time. It was great to present this to you, and we look forward to your feedback as always, and make sure that you're sharing your progress and your great feedback onto the groups, and we will look forward to hearing from you soon. All the best in your trading. Take care.